Hello, great to have you back here. In this video, I'm going to talk to you about CFD trading and what are CFDs in general. If you're new to trading, you will find this video very useful. Lots of information that will help you to get into CFD trading. So let's dive in. First of all, please do remember that we don't provide any investment advice and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. So, what is a CFD? A CFD is a financial contract between a buyer and a seller where the buyer agrees to pay the seller the difference between the opening and closing prices of the underlying asset. The underlying asset could be a stock, it could be a currency or commodity or index. And the difference between the prices determines the profit or loss for the trade. So if the price of the underlying asset rises, say it's a stock index for instance, the buyer makes a profit, and if the price falls, the buyer has a loss. Similarly, if the price of the underlying asset falls, the seller makes the profit, and if the prices rise, the seller incurs a loss. Let's take a look at benefits of CFD trading. Low minimum account balance required to start trading. This is a big one. Unlike traditional trading, CFD trading allows you to start trading with a low minimum amount, say like $10 with TIO markets. If you want to trade with stocks or futures, then you often have to pay quite a bit of money into your account before you can start trading. Then ability to trade on margin. CFD trading allows you to trade on margin, meaning you can open larger positions than your account balance would allow in traditional trading. This obviously can increase your profits, but also carries a bigger risk of potential loss. Then number 3, no ownership of the underlying asset required. So with CFD trading, you really don't need to own the underlying asset, which means that you don't have to pay the full price of the asset, which obviously makes trading more affordable. CFD trading allows you to trade both rising and falling markets. So basically, with CFD trading, you can take advantage of both rising and falling markets, giving you more opportunities than you would have in traditional markets like stocks. Sometimes it's difficult to short some of the stocks. They may not be available or it might be expensive. But with CFDs, there is no question whether you can short the market. You can always go long and short. Then access to wide range of financial instruments. This is a big one. CFDs offer wide access to the world markets. You can trade stocks, you can trade currencies, you can trade commodities, and this really allows you to diversify your trading business and find more potential in the markets on any given day. Then CFD trading offers flexibility in terms of position size. With CFD trading, you have the flexibility to choose your position size, which means you can open positions as small as one micro contract or one micro lot. This means your risk, the minimum risk, is really, really small. And then lastly, CFDs are offered on highly liquid markets. So you can trade markets that are very liquid, means that there are large number of buyers and sellers. It really makes it easy for you to enter and exit trades quickly and efficiently. What about risks and other considerations? So first of all, CFD trading can offer great opportunities in terms of profit. But it's also important to remember that there are risks involved, like in any financial transactions. So one significant risk is the high volatility in the markets, but this can be managed. If you see market being very volatile, you can wait for them to calm down and only trade when you feel safe, when you see your edge present in the market, and then you take the trades. Another risk is that CFD trading involves leverage. So this basically means that you can potentially lose more than your initial allocation to this trade. So it's important to consider your own risk tolerance and have a clear understanding and plan on how you trade before you take those trades. Okay, what do you need to get started with CFD trading? To get started with CFD trading, you need to open an account with a broker. Choosing a reliable and trustworthy broker is crucial for your success in CFD trading. Look for a broker with good reputation, competitive fees, and a user-friendly customer support. And I can recommend TIO Markets in this regard. Our customer support is excellent. We have very competitive pricing for all traders. And then once you have selected broker, and I hope it is TIO Markets, you can start selecting the financial instruments you want to trade. It's important to do your own research and analyze the markets before making any trading decisions. So consider factors such as how the markets trend, what economic indicators impact those markets, what news events are coming on each day, and whether the markets are volatile or less volatile at the time. So all these considerations need to be taken into account when you are creating your trading plan. Then the strategies for successful CFD trading. Technical analysis is really the most popular analysis method among the traders. It involves analyzing charts and indicators to identify trends and potential entry and exit points. There are strategies such as trend following, breakouts, and support and resistance levels that are very popular technical analysis based strategies that traders use to make better and more informed trading decisions. In addition to technical analysis, traders sometimes also use fundamental analysis, which involves analyzing economic and financial data to identify potential market movements. Fundamental analysis can help traders to make better trading decisions if they know what they're doing. Lastly, I want to talk to you about risk management and the importance of a trading plan. So effective risk management is essential for traders who want to increase their chances of success in the markets and who want to be constantly successful. And therefore, basics like using a stop loss orders is a must. No one can sustain a trading business for an extended period of time without protective stop loss orders. A stop loss order is an order placed with your broker that will automatically close your trade if the market moves against you by a certain amount. So by setting a stop loss order, you can limit your potential losses and protect your capital, because there'll be times when you are wrong. There'll be losing trades, and there's just no way around it. So you have to cap your losses in one way or another. And stop losses are the way to do that. Another key way of managing risk is to determine the appropriate position size for your trades. This basically means you calculate the amount of capital you're willing to risk on each trade based on your account balance and your risk tolerance. By setting your position size correctly, you can minimize the impact of potential losses on your overall account balance. So if you're a new trader, you might want to risk only 0.5% of your account balance per trade. If you're a more experienced trader, you might want to cap your maximum risk to 2%. Then additionally, it's important to monitor your open trades and make adjustments as necessary to minimize the risks. This basically might mean that you close part of your position if you anticipate that the market could soon move against you. So you take some of the profits in, you make the trade risk-free in a sense that you have covered the potential loss. Some traders take part of the profit and bring their stop loss to the entry level to make sure that the trade is profitable. This can be done after the market has moved some distance in your favor. Finally, every business needs a business plan. So your trading business needs a trading plan, and sticking to it is essential for effective risk management. I can't emphasize this enough. Most traders trade without the plan and they keep on losing money. So you can be different. Creating a trading plan basically means setting clear goals for your trades, determining your entry and exit points beforehand, and avoiding emotional decision making and impulsiveness. By having a trading plan in place, you can minimize the impact of market volatility and stay focused on your long-term trading objectives. So, in summary, we could say that effective risk management is the most important thing for traders who want to succeed. You gotta use stop loss orders. You have to determine appropriate position sizes. You need to monitor your open trades. And before doing all of this, you need to have a solid trading plan. Thank you for watching, guys. If you found the video helpful, maybe you can give us thumbs up, and also you can go to tiomarkets.com/videos to learn more about trading. So until the next time, take care and happy trading.